The shift now unfolding in global financial markets is not sudden, but it is decisive. A massive accumulation of risk that built quietly over more than a decade has crossed a threshold where delay is no longer possible. Capital that once depended on low rates, abundant liquidity, and constant refinancing is being forced to confront a radically different environment. What makes this moment dangerous is not a single shock, but the synchronization of pressures across credit markets, asset valuations, and institutional balance sheets. The structures designed after the last crisis assumed that time, liquidity, and central bank credibility would always be available. Those assumptions are being tested simultaneously. What is emerging is not panic, but a repricing of reality. The consequences will not be confined to financial firms. They will extend into employment, investment, and policy space. This is the point where long-ignored vulnerabilities become unavoidable. As the global economy navigates the aftermath of persistent inflationary pressures and uneven growth trajectories, in late 2025, the escalating scale of leveraged exposure within opaque financial segments emerges as a pivotal vulnerability threatening systemic stability. This issue commands immediate attention because it intersects directly with the current environment of moderating interest rates and heightened geopolitical tensions, where central banks are cautiously easing policy amid signs of decelerating corporate earnings and rising refinancing needs. With the Federal Reserve having initiated rate cuts earlier this year, the illusion of ample liquidity has masked underlying fragilities in credit markets. But recent data indicates that private credit defaults eased only marginally to 5.2% in October, signaling that stress is building rather than abating. This leveraged ecosystem, now encompassing an estimated $2.1 trillion in private credit alone, amplifies the risk of abrupt deleveraging events that could cascade through interconnected financial institutions, disrupting capital allocation at a time when global trade volumes are contracting due to ongoing supply chain realignments and tariff escalations between major powers. In this context, the problem is not merely a domestic U.S. concern, but a global one, as cross-border capital flows tie European insurers and Asian sovereign funds to these assets, potentially exporting U.S.-originated shocks to regions already grappling with debt overhangs from the pandemic era. The criticality stems from the mismatch between the perceived resilience of these markets and their actual sensitivity to even modest shifts in economic sentiment, where a sudden repricing could erode trillions in asset values and constrain credit availability precisely when fiscal stimuli are waning. Tracing the origins of this leveraged buildup reveals a pattern rooted in post-2008 financial reforms that inadvertently accelerated the migration of risk from regulated banking channels to shadow financing structures. Following the global financial crisis, stringent Basel III capital requirements prompted banks to offload higher-risk lending to non-bank entities, fostering the proliferation of private credit funds and leveraged loan syndications. By 2010, private corporate loans totaled a modest $310 billion, but a decade of ultra-low interest rates engineered by central banks to stimulate recovery created a yield famine, driving institutional investors toward these alternatives. This growth mirrored historical cycles, such as the 1990s expansion of asset-backed securities and the early 2000s boom in structured investment vehicles, which similarly concealed leverage through off-balance sheet mechanisms until liquidity crunches exposed their flaws. Policy failures compounded the issue. For instance, the Federal Reserve's quantitative easing programs suppressed bond yields, compelling pension funds and insurers to allocate billions into illiquid assets promising higher returns, often without commensurate risk adjustments. Unlike past episodes, the current situation is structurally more dangerous due to the sheer magnitude and concentration. Private credit has ballooned to $1.7 trillion by mid-2025, representing a third of the broader leveraged finance market, while off-balance sheet vehicles now embed trillions in contingent liabilities that evade standard regulatory scrutiny. This opacity exceeds that of the pre-2008 subprime mortgage era, where at least public markets provided some pricing transparency. Here, infrequent valuations and bespoke deal structures obscure deteriorating borrower fundamentals, making early detection of stress nearly impossible until defaults surge. Delving into the mechanics, the expansion of leveraged exposure operates through a layered system of capital flows and debt amplification that begins with low interest rates distorting investor behavior. Institutions facing compressed yield. DS on sovereign bonds and investment-grade corporates have funneled capital into private credit and leveraged loans, where borrowers, often middle-market firms with EBITDA under $100 million, access funding at leverage multiples exceeding 6 times earnings. This process involves structuring products like collateralized loan obligations, where pools of leveraged loans are tranched into securities sold to yield-hungry buyers, including pension funds holding an estimated 15–20% of such assets. Debt dynamics are central. As rates hovered near zero for years, refinancing assumptions embedded optimistic rollovers, but with base rates now above 4% despite cuts, interest coverage ratios for many borrowers have dipped below 1.5, straining cash flows. Inflation exacerbates this by eroding real revenues in sectors like consumer goods, while labor market tightness, evidenced by U.S. unemployment ticking up to 4.2% in November 2025, increases operational costs, further pressuring margins. Policy logic underpins the vulnerability. Central banks' forward guidance encouraged risk-taking, but the off-balance sheet nature means these exposures are not captured in standard balance sheet metrics, allowing banks to extend $79 billion in revolving credit lines to private credit funds with utilization rates around 56%. When defaults rise, as seen in the 10.9% rate for smaller EBITDA firms, these lines get drawn, transferring risk back to banks and amplifying losses through interconnected funding chains. Market reactions to this leveraged overhang are manifesting in subtle but telling pricing signals across asset classes, where institutional investors are beginning to demand higher premiums for illiquid holdings. Equities in financial sectors have shown volatility, with bank stocks dipping 3–5% in recent weeks amid reports of increased provisions for private credit exposures, reflecting anticipatory hedging against potential write-downs. Bond markets, particularly high-yield segments, are pricing in contagion risks, with spreads widening by 50 basis points since September as traders anticipate spillovers from private defaults into syndicated loans. Currencies are not immune. The US dollar's strength against emerging market peers masks underlying pressures, but any deleveraging could trigger safe haven flows that paradoxically strengthen it further, exacerbating dollar-denominated debt burdens abroad. Commodities, tied to borrower health in energy and materials, have seen oil futures soften despite geopolitical tensions, as investors interpret weakening cash flows in leveraged producers as a demand signal. Institutional behavior drives this. Asset managers, holding concentrated positions in structured products, are rotating toward shorter duration assets, but the opacity means pricing adjustments lag public narratives. Markets often react via derivative indicators like credit default swaps spiking before headlines confirm stress, as occurred in the third quarter when private credit distress monitors rose modestly amid borrower downgrades. Policymakers face severe constraints in addressing this buildup, as interventions risk unintended amplification of the very problems they seek to mitigate. Central banks, including the Federal Reserve, can provide liquidity through repo facilities or targeted asset purchases, but extending these to private markets would undermine post-crisis reforms and invite moral hazard, encouraging further risk-taking. They cannot, without causing damage, bail out non-bank entities directly, as this would erode credibility and spark political backlash amid fiscal deficits exceeding 6% of GDP. Trade-offs are stark. Easing rates further to aid refinancing could reignite inflation, already hovering at 2.5% core PCE, while tightening would accelerate defaults in a system where median leverage in private credit borrowers exceeds bank loan norms. Political pressures compound this. With midterm elections looming in 2026, governments may prioritize short-term growth over structural reforms, delaying necessary oversight enhancements like expanded reporting for off-balance sheet vehicles. Credibility risks loom large if markets perceive policy as reactive rather than proactive. Confidence could falter, leading to self-fulfilling runs on funds. The spillover effects of stress in this leveraged ecosystem extend far beyond U.S. borders, intertwining with global financial architectures in ways that heighten interconnected vulnerabilities. In the United States, banks' $95 billion in exposures to private credit, via lines and term loans, could strain capital ratios, forcing curtailed lending to households and businesses, potentially shaving 0.51% off GDP growth. China, with its own shadow banking parallels, faces indirect hits through commodity trade. Weakened U.S. borrower demand could depress exports, pressuring the renminbi and prompting Beijing to accelerate stimulus, which in turn risks inflating global asset bubbles. Russia and BRICS economies, reliant on commodity revenues, would encounter currency depreciation if deleveraging suppresses prices, exacerbating fiscal strains and fostering reliance on alternative payment systems that fragment global finance. Europe, where insurers hold significant U.S. private credit allocations, risks solvency pressures under Solvency II rules, potentially triggering asset sales that depress Eurozone bond yields and hinder ECB normalization. Emerging markets bear the brunt. Dollar strength from U.S. stress could ignite capital outflows, raising borrowing costs for sovereigns and corporates, with trade disruptions amplifying currency mismatches in regions like Latin America. Overall, financial system consequences include heightened volatility in cross-border flows, straining IMF resources, and accelerating de-dollarization trends among affected nations. Escalation paths materialize through self-reinforcing feedback loops, where initial stress in one segment cascades across the system. A trigger, such as a cluster of high-profile defaults in overleveraged sectors like technology or real estate, could prompt fund redemptions, forcing sales in illiquid markets and evaporating liquidity. Historical precedents show bid-ask spreads widening tenfold in such scenarios. Second-order effects include bank drawdowns on credit lines, depleting reserves and curbing broader lending, which in turn weakens corporate cash flows and accelerates further defaults. Third-order ramifications involve contagion to public markets. As institutional holders de-risk, equity sell-offs could depress valuations, impairing collateral for leveraged positions and creating a doom loop. Accelerants include sudden rate reversals if inflation reemerges, or geopolitical shocks disrupting supply chains, both of which erode borrower resilience and heighten the probability of synchronized deleveraging events. Looking to the 2025-2026 horizon, the short-term trajectory points to contained but mounting pressures, with private credit defaults likely stabilizing around 5–6% by year-end amid easing rates. Yet refinancing walls in early 2026 could push them higher if growth falters below 1.5%. Medium-term structural consequences include a reconfiguration of capital markets, where heightened scrutiny prompts a shift toward transparent instruments, potentially contracting credit availability by 10–15% and slowing investment in growth sectors. This evolution impacts global power dynamics. U.S. financial dominance may wane if repeated stresses erode investor confidence, bolstering alternatives like BRICS-led frameworks, while stability in emerging markets could suffer from persistent capital scarcity, fostering inequality and unrest. The financial architecture faces reform imperatives, with enhanced non-bank regulation likely emerging, though implementation lags could prolong vulnerabilities. In conclusion, the outsized growth of leveraged exposure in opaque channels represents a core imbalance in contemporary finance, with evidence from current market metrics underscoring the need for vigilant monitoring and preemptive policy calibration to avert broader disruptions. As the global financial system contends with the lingering effects of elevated borrowing costs in late 2025, the erosion of financial viability in leveraged structures due to higher interest rates stands out as a paramount concern demanding urgent scrutiny. This dynamic is critically important at this juncture because, even as the Federal Reserve has implemented successive rate cuts, bringing the federal funds rate to a range of 3.5 to 3.75%, following a 25 basis point reduction in December, the legacy of prior rate hikes continues to strain balance sheets across private credit and leveraged loan markets. With inflation stabilizing but persistent at around 4.1% in OECD economies as of August, central banks remain vigilant against premature easing that could rekindle price pressures, thereby prolonging an environment where debt servicing burdens outpace corporate cash flow generation. Situated within the broader geopolitical landscape, this vulnerability intersects with escalating US-China trade frictions and energy market volatilities stemming from Middle Eastern tensions, which are compressing corporate margins and amplifying the risk of widespread defaults. Global GDP growth, while robust at 4.3% annualized in the third quarter for the United States, is projected to decelerate to 1.9% in 2026, underscoring a softening trajectory that exacerbates the mismatch between elevated rates and economic resilience. The private credit market, now valued at approximately $1.7 trillion and representing a significant portion of institutional portfolios, faces heightened default risks as borrowers grapple with interest expenses that have doubled or tripled from low-rate eras, potentially triggering liquidity squeezes that ripple through interconnected financial networks. In this unfolding scenario, the issue transcends isolated sectors, embedding itself as a systemic threat that could undermine post-pandemic recovery efforts and intensify cross-border financial strains amid shifting alliances in global trade. Examining the historical underpinnings, the current predicament echoes patterns from previous monetary tightening cycles, such as the 1994 Federal Reserve rate hikes that precipitated the Mexican peso crisis and exposed leveraged positions in emerging markets, or the 2004-2006 tightening that foreshadowed the subprime mortgage collapse by stressing adjustable rate debts. In those instances, policy shifts from accommodative stances caught markets off guard, but the post-2008 era's prolonged quantitative easing created an even more pronounced distortion, with rates near zero fostering a reliance on cheap debt for growth. Policy missteps, including the European Central Bank's delayed response to inflation in the early 2020s, mirrored U.S. actions and accelerated the migration to floating-rate instruments in private markets. However, the present situation is structurally more perilous because the scale of leverage has ballooned exponentially. Private credit assets have grown from $310 billion in 2010 to over $2.1 trillion today, fueled by a decade of suppressed yields that encouraged risk layering without adequate buffers. Unlike earlier cycles, where public market transparency allowed for gradual adjustments, the opacity of modern structures, comprising bespoke loans and off-balance sheet vehicles, delays recognition of distress, as evidenced by the gradual climb in U.S. private credit defaults to 5.7% in early 2025, a level that surpasses pre-tightening norms and signals embedded fragilities that prior reforms failed to fully address. This amplification arises from the entrenchment of floating-rate exposures, where even modest rate elevations translate into immediate cash flow impairments, contrasting with the fixed-rate dominance of past booms that afforded more refinancing flexibility. Breaking down the mechanisms, the undermining effect commences with the foundational shift in borrowing costs. Structures originated in the 2010s assumed perpetual low rates, often embedding floating benchmarks like SOFR plus margins of 400-600 basis points, which appeared manageable when base rates lingered below 1%. As rates ascended from near zero to peaks above 5% in 2023-2024, debt service ratios for leveraged borrowers deteriorated, with interest coverage falling below 1.5 times for many mid-market firms, compelling them to divert cash from operations to payments. Capital flows play a pivotal role. Institutional inflows into private credit surged during low-rate periods, reaching $1.3 trillion in U.S. exposures alone, as pension funds and insurers chased yields amid compressed sovereign returns. Debt dynamics intensify the strain. Floating obligations mean immediate transmission of rate hikes, unlike fixed debts, leading to a 30-50% increase in annual interest outlays for typical leveraged loans. Inflation interlinks here, eroding real revenues through higher input costs. Global core inflation, is forecasted to rise to 3.4% annualized in the second half of 2025, while labor markets, with U.S. unemployment at 4.2% and wage growth moderating to 3.5%, constrain firms' ability to pass on expenses without margin erosion. Policy logic undergirds this. Central banks pivot to restriction aimed at quelling post-pandemic inflation, but the lag in private market adjustments means refinancing at higher rates narrows windows, testing covenants like debt-to-EBITDA caps that were calibrated for benign conditions. Step by step, this cascades. Weakened cash flows prompt covenant breaches, triggering penalty rates or forced asset sales, which in turn depress valuations and amplify losses in a feedback of declining collateral quality. Pricing signals in markets are already reflecting this erosion, with high-yield bond spreads widening by 75 basis points since mid-2025, as investors price in elevated default probabilities, while leveraged loan indices show secondary prices dipping to 90 to 94 cents on the dollar for riskier tranches. Equities in rate-sensitive sectors like real estate and consumer discretionary have underperformed, with indices shedding 4.6% in the fourth quarter amid earnings revisions downward by 2.3% for 2026. Currencies respond through safe haven dynamics. The U.S. dollar has appreciated 5% against a basket of emerging market currencies this year, exacerbating foreign-denominated debt burdens and fueling commodity price volatility, where oil has fluctuated between $70–80 per barrel despite demand softening. Institutional investors, interpreting these as harbingers of broader SDRs, are reallocating towards shorter-duration treasuries, with mutual fund outflows from credit strategies reaching $15 billion in November alone. Markets preempt public narratives because algorithmic trading and derivative positions, such as credit default swaps with premiums up 20%, amplify early signals from borrower disclosures, allowing sophisticated players to hedge before mainstream media amplifies the concerns, as seen in the leveraged loan default rate easing marginally to 1.5% in Q3, but with forecasts pointing to 4.55% by end 2026. Central banks and governments are hemmed in by constraints that limit effective mitigation without collateral damage. Policymakers can deploy targeted liquidity injections, such as expanding repo operations or purchasing distressed assets via facilities akin to the 2020 corporate credit facilities, to stabilize short-term funding. However, they cannot indiscriminately lower rates below neutral levels, estimated at 3% for the Fed, without reigniting inflation, which could spike to 3–4% globally if stimulus overshoots, eroding purchasing power and necessitating even sharper future hikes. Credibility is at stake. Repeated interventions risk perceptions of favoritism toward financial sectors, especially with U.S. fiscal deficits at 7% of GDP, inviting political scrutiny from lawmakers prioritizing consumer relief over institutional bailouts. Trade-offs abound. Easing to support refinancing might buoy growth but inflate asset bubbles, while maintaining restraint preserves anti-inflationary stance at the cost of higher defaults, projected at 4.5% for speculative-grade credits by September 2026. Political pressures, amplified by 2026 elections in key economies, may tilt toward fiscal expansions, yet these could crowd out private borrowing and heighten sovereign risk premia. Spillovers radiate globally, with differentiated impacts. In the United States, sustained high rates could curtail credit extension by 10–15%, dampening investment and contributing to GDP deceleration from 4.3% in Q3 2025 to sub-2% in 2026, while straining household balance sheets through variable mortgage resets. China, facing its own property sector woes, encounters indirect pressures via reduced export demand from U.S. firms, potentially weakening the renminbi by 5–7% and prompting Beijing to inject 2 trillion yuan in stimulus, which risks global commodity inflation. Russia and BRICS nations, leveraging alternative currencies, may see ruble volatility if energy revenues falter from softened demand, fostering deeper ties in non-dollar trade systems that fragment payment infrastructures. Europe contends with ECB rates at 2.75%, where insurers' exposures to U.S. leveraged assets could necessitate 20-30 billion euros in provisioning, slowing recovery in peripheral economies like Italy and Spain. Emerging markets suffer acutely. Capital outflows of $100 billion annually could elevate borrowing costs by 100-200 basis points, triggering currency depreciations of 10% in nations like Brazil and India, with trade disruptions from supply chain rerouting amplifying fiscal strains and widening current account deficits. Escalation unfolds via self-reinforcing loops, where initial rate-induced defaults, such as those climbing to 5-6% in private credit, prompt fund redemptions, depleting liquidity and forcing fire sales that further depress asset values. Second-order effects include bank balance sheet impairments from drawn credit lines, reducing lending capacity by 5-10%, and constricting economic activity. Third-order consequences encompass contagion to equity markets, where valuation multiples contract by 15-20%, impairing corporate fundraising and perpetuating a cycle of deleveraging. Triggers accelerating this include unexpected inflation surges above 3%, geopolitical disruptions like oil supply shocks pushing Brent above $90, or a cluster of covenant breaches in Q1 2026 amid maturing debt walls exceeding $300 billion. Projecting into 2025-2026, the short-term path involves persistent but contained stress, with leveraged loan defaults stabilizing around 4-5% by mid-2026 as rate cuts provide partial relief, though refinancing challenges persist for 20% of outstanding debt. Medium-term ramifications entail a structural recalibration, with private credit growth slowing to 10% annually from prior doubles, fostering tighter underwriting and reduced leverage multiples to 4-5 times EBITDA. This reshapes global power. U.S. financial hegemony may erode if recurring stresses bolster multipolar alternatives, while stability in emerging regions falters from chronic capital scarcity, heightening social tensions. Financial architecture evolves toward enhanced non-bank oversight, potentially integrating digital ledgers for transparency, though transitional frictions could prolong vulnerabilities. In conclusion, the systemic mismatch exposed by elevated interest rates in leveraged frameworks constitutes a fundamental challenge to financial resilience, with prevailing indicators necessitating proactive surveillance and calibrated interventions to mitigate cascading disruptions. As global financial markets approach the end of 2025, with persistent volatility stemming from geopolitical uncertainties and uneven economic recovery, the subtle yet consistent repricing across asset classes signals an ongoing adjustment to heightened systemic risks without descending into outright panic. This development is critically important now because it reflects a broader recalibration of investor expectations amid moderating inflation, which has eased to 2.4% in the United States as of November, and central bank rate cuts that have reduced the federal funds rate to 4.25450%, yet failed to fully alleviate pressures in leveraged segments. Placed within the current global environment, these signals intersect with escalating trade tensions between the United States and China, where tariffs have contributed to a 3.2% contraction in bilateral trade volumes this year, and energy market disruptions from Middle Eastern conflicts that have kept Brent crude oscillating around $75 per barrel despite OPEC plus production adjustments. Institutional flows indicate a shift toward defensive positioning, with pension funds and insurers increasing allocations to shorter duration assets by 12% in the third quarter, underscoring concerns over prolonged high borrowing costs that could erode corporate margins further. The absence of disorderly movements masks underlying fragilities, as credit availability tightens selectively for lower-rated borrowers, potentially amplifying downturns in sectors like commercial real estate, where vacancy rates have climbed to 18.5% nationally. This adjustment phase, while orderly, heightens the risk of abrupt corrections if exogenous shocks materialize, such as escalation in regional conflicts or a resurgence in core inflation above the Federal Reserve's 2% target, thereby demanding vigilant monitoring to preserve financial stability in an interconnected system where cross-border exposures total over $45 trillion. Historical precedents illustrate that such gradual repricings often precede more pronounced market stresses, as seen in the 2018-2019 tightening cycle, when the Federal Reserve's rate hikes led to a 20 basis point widening in high-yield spreads before public awareness caught up, or the 2006-2007 period, where subprime mortgage signals manifested in selective credit tightening prior to the global financial crisis. In those episodes, policy failures like delayed recognition of liquidity mismatches in shadow banking amplified vulnerabilities, much as today's opaque private credit markets echo the pre-2008 structured product boom. The current situation is structurally more dangerous due to the unprecedented scale of leveraged exposures, now exceeding $3.5 trillion in private credit and leveraged loans combined, coupled with a higher concentration among non-bank intermediaries, whose assets have grown 15% annually since 2020. Unlike past cycles where public market transparency facilitated early interventions, today's signals are embedded in illiquid structures with infrequent valuations, allowing distress to build undetected until covenant breaches surge, as evidenced by a 25% increase in such incidents in the first half of 2025. Moreover, the integration of geopolitical risks, absent in prior U.S.-centric tightenings, adds layers of complexity, with commodity-linked currencies depreciating by an average of 8% against the dollar this year, signaling broader emerging market strains that could feed back into developed economy asset prices through reduced global demand. The mechanics of this adjustment begin with equity markets incorporating balance sheet scrutiny, where firms with leverage ratios above 4 times EBITDA face heightened volatility, as investors demand premiums for funding exposures amid rising refinancing costs that have pushed average interest coverage to 2.8 times from 3.5 in 2023. Capital flows redirect toward quality, with institutional inflows into investment-grade equities surging 18% in 2025, driven by labor market softening, U.S. unemployment at 4.3%, that compresses wage growth to 3.1% and erodes consumer spending power, thereby weakening cash flows for leveraged entities. Debt dynamics intensify this, as central banks maintain restrictive stances to combat inflation lingering at 2.6% globally. Borrowing costs remain elevated, with SOFR at 4.1%, straining variable rate obligations that constitute 65% of leveraged loans. Inflation interplays by inflating input costs in commodity-dependent sectors, where price pass-through is limited due to competitive pressures, further pressuring margins and prompting selective spread widening of 40 basis points in private credit since mid-year. Policy logic sustains the trend. Forward guidance from the European Central Bank and Federal Reserve emphasizes data dependence, leading investors to interpret mixed signals, like a 1.8% GDP growth forecast for 2026, as cues for cautious positioning, resulting in step-by-step repricings that embed risks before narratives shift. Equities exhibit increased sensitivity, with the S&P 500 Financial Subindex declining 2.7% in the fourth quarter amid concerns over exposure to leveraged borrowers, while broader indices rally modestly by 4.1% year-to-date on expectations of policy easing. Bonds reflect this through selective widening, with leveraged loan spreads at 397 basis points for B- credits, up from 353 earlier in the year, as transparency limitations in private markets prompt risk premiums of 8,100 basis points above syndicated equivalents. Currencies adjust via strengthened dollar appreciation of 4.5% against emerging market baskets, incorporating settlement risks in commodity trades, where oil volatility has led to a 15% premium in forward contracts. Commodities show tempered movements, with gold holding above $2,300 per ounce on safe haven demand, while industrial metals softened 3.2% due to subdued manufacturing PMI at 48.9. Institutional investors interpret these as precursors to liquidity constraints, reallocating $22 billion from high-yield funds in November, viewing them as behavioral shifts rather than crashes, as derivative volumes in credit default swaps rise 18% to hedge tail risks. Markets react preemptively because algorithmic models and high-frequency data capture subtle imbalances, such as a 10 basis point Treasury yield uptick signaling reduced foreign demand, before media amplifies the narrative. Policymakers retain tools like targeted liquidity facilities, with the Federal Reserve able to expand repo operations by up to $500 billion to stabilize short-term funding, or the European Central Bank injecting €150 billion via long-term refinancing to support bond markets. However, they cannot aggressively cut rates below 3.5% without risking inflation resurgence to 3%, which would necessitate sharper reversals and erode market confidence. Credibility risks arise from political pressures, with 2026 elections influencing fiscal expansions that could add $1.2 trillion to U.S. deficits, forcing trade-offs between growth support and debt sustainability, where prioritizing the former might widen spreads by 50 basis points. Central banks face constraints in direct private market interventions, as moral hazard concerns limit bailouts, potentially damaging non-bank sectors reliant on $1.7 trillion in opaque funding. Spillover effects vary regionally, with the United States experiencing moderated lending growth of 2.1%, as banks provision $45 billion against leveraged exposures, constraining small business credit and trimming GDP forecasts by 0.4%. China absorbs indirect hits through commodity demand softening, depreciating the renminbi by 6.2% and accelerating 1.5 trillion yuan in fiscal stimulus to offset export declines of 4%. Russia and BRICS economies face currency volatility, with the ruble down 9% amid oil revenue shortfalls of $120 billion, deepening non-dollar trade reliance that fragments global payments by 15%. Europe contends with insurer write-downs of €25 billion on U.S. leveraged holdings, slowing ECB easing and depressing Eurozone growth to 1.1%. Emerging markets endure capital outflows of $180 billion, elevating sovereign yields by 150 basis points and widening current account deficits to 3.8% of GDP, with trade disruptions amplifying currency mismatches in dollar-denominated debt totaling $12 trillion. Financial system consequences include heightened cross-border volatility, straining IMF lending capacity by 20%, and accelerating de-dollarization in commodity settlements. Escalation reinforces through loops where initial spread widening prompts redemptions of $35 billion from private credit funds, depleting liquidity and forcing asset sales that depress prices further by 5-7%. Second-order effects encompass bank exposures drawing down $80 billion in credit lines, reducing overall lending by 8% and constricting economic activity. Third-order impacts involve equity contagion, with multiples contracting 12% and impairing collateral values in a cycle that elevates default rates to 6%. Triggers include inflation spikes above 2.8% from supply shocks, or geopolitical events, pushing oil beyond $85 per barrel, accelerating deterioration amid maturing debt walls of $450 billion in early 2026. The short-term trajectory for 2025-2026 anticipates stabilized adjustments, with spreads holding at 450 basis points by mid-2026 as rate cuts provide relief, though selective defaults rise to 4.5% in lower-rated segments. Medium-term consequences involve structural shifts, with private credit contracting 8% annually and leverage multiples falling to 5 times EBITDA, fostering tighter standards. This impacts global power by eroding U.S. financial dominance as BRICS alternatives gain 10% market share, while stability falters in emerging regions from capital scarcity, heightening unrest. Financial architecture adapts via enhanced oversight, integrating real-time reporting to mitigate opacity, though lags prolong risks. In conclusion, the orderly yet directional market signals of adjustment underscore a pivotal phase in financial repricing, with integrated data highlighting the imperative for sustained oversight and adaptive strategies to navigate embedded vulnerabilities. As of December 26, 2025, policymakers confront a severely constrained set of options in addressing mounting pressures in leveraged credit markets and broader financial vulnerabilities. The narrow policy corridor is evident: rapid easing of financial conditions through aggressive rate cuts or large-scale asset purchases risks reigniting inflation that has only recently moderated to 2.42% core in major economies and would likely undermine central bank credibility already tested by the 2021-2023 inflation surge. Conversely, maintaining restrictive policy settings, with real rates still positive in most developed markets, heightens the probability of accelerating defaults, particularly in the $1.72 trillion private credit universe where interest coverage ratios for many borrowers have fallen below 1.5 times and could tip economic growth, already projected at just 1.719% for 2026 in the US and Euro area, into a sharper slowdown. Heavy-handed interventions, such as direct liquidity support to non-bank lenders or targeted bailouts of distressed private credit funds, carry a different but equally serious risk. They reinforce perceptions that access to the core financial infrastructure is conditional on systemic importance. Such actions could accelerate capital flight toward alternative arrangements, decentralized finance platforms, cross-border stablecoin networks, and bilateral currency swap lines outside traditional correspondent banking. Transaction volumes on major public blockchain networks have already risen 28% year-on-year in 2025, partly reflecting institutional experimentation with settlement alternatives. The challenge is fundamentally structural rather than tactical. Post-war financial dominance of the US dollar and Western banking system has historically rested on three pillars: trust in rule of law and contract enforcement, openness of capital accounts, and depth of liquid markets. When alternatives, however imperfect, become functionally viable, the system loses its centralized character and becomes harder to steer through conventional monetary tools. The current environment marks the early stages of such a transition toward a more fragmented global financial architecture, evidenced by the 14% increase in renminbi-denominated trade settlement among BRICS countries this year, and the growing use of local currency bilateral swap lines. Managing this transition without triggering instability is exceptionally difficult. Authorities can realistically employ modest, targeted measures, expanding central bank standing facilities to include more non-bank counterparties, issuing clearer guidance on lender of last resort principles, and strengthening cross-border supervisory cooperation. They cannot, however, reverse the underlying geopolitical and technological drivers of fragmentation without unacceptable costs. Capital controls would destroy credibility, while aggressive rate cuts risk a renewed inflation wage spiral. Primary risk is not an immediate collapse but cumulative strain that progressively reduces resilience. Each cycle of stress depletes buffers. Banks tighten credit standards, non-bank lenders face redemption pressures, corporates cut investment, and governments face narrower fiscal space. Over time, this erosion lowers the system's shock absorption capacity, making it more brittle to future disturbances, whether from commodity price shocks, regional conflicts, or renewed inflationary pressures. In the near term, Q2 2026, expect cautious, incremental policy steps, likely another 50-75 basis points of rate cuts by major central banks, balanced against hawkish rhetoric to anchor inflation expectations. Medium term, the fragmentation trend is likely to deepen unless coordinated international efforts restore confidence in the existing architecture. In conclusion, the narrow range of viable policy responses itself contributes to the structural shift toward a less centralized financial system. Authorities must navigate this transition with extreme care. Overt action risks accelerating the very trends they wish to contain, while inaction allows resilience to degrade gradually. The balance remains precarious.